Welcome to Tax Insights, presented by Hawkins Ash CPAs.
Good morning, listeners. Welcome back to an all-new episode of Tax Insight here on the Lakeshore's Good Neighbor, WOMT. Every week we got Jeff from Hawkins Ash here in Manitowoc. Jeff, good morning.
Good morning, Terry.
Cost segregation studies, that's the topic of the day.
That's right, because these cost segregation studies can be a great way to accelerate depreciation and save taxes today rather than waiting for years to take a depreciation deduction. So let's talk about how a property owner can save some money.
So let's start off with first and foremost explaining what exactly is a cost segregation study.
So a cost segregation study allows a property owner to break up the cost of the building into different components. Things like carpeting, electrical, HVAC, just different parts of the building. And some of these components can then be depreciated faster than the building itself.
So how much faster then?
Well, it depends. Normally a building is depreciated or written off over a period of 27 and a half years if it's a residential property, or 39 years if it's a commercial property. But if part of the building can be considered to be like a leasehold improvement or personal property, those parts can be depreciated over maybe 15, 7, or even 5 years. So this can be a big timing difference.
That absolutely is a big time difference. Explain that a little bit more.
Yeah, and to make it even better, many times these 15-year, 7-year, or 5-year properties can be written off all in the first year. This is done by electing bonus depreciation or Section 179. Now, I don't like to throw code sections around, but most business owners do know what Section 179 is.
All right, so for those that don't know, what is Section 179?
It's an election that certain business owners can take to write off an asset in the year that they purchase it. In order to take advantage of this election, though, the business must have income. And there's another election that can be made for those businesses that don't have income. And that's bonus depreciation, which allows also a full write-off, at least for this year, 2022.
Isn't this just a timing difference on when you can actually take the depreciation, or it does not give you any additional depreciation, right?
Right. So that's correct. It's all about timing, unless you use some other tax deferral or elimination strategies.
Can you give us some examples?
Sure. A building owner can actually use what's called a like-kind exchange to defer the tax even longer. Let's say they take faster write-off now, and then they sell the building. They can either pay the tax on the gain at the time that they sell it, or they can roll that gain into another business property. Other things people do is they can keep the property until they pass away, and the beneficiaries get the benefits of the step up in basis, which allows them to depreciate the asset all over again. So there's different ways that you can push the gain down the road or eliminate it altogether.
Right. Jeff, time is running out here on today's program, but I got to ask you, is this something that Hawkins Ash can do?
We can do quite a bit of assisting when it comes to planning, but the cost study itself really needs to be done by somebody with an engineering background. And there's plenty of companies out there that do this kind of thing.
Gotcha. Jeff, thank you for the time. How do listeners connect with the team over at Hawkins Ash?
I would go to our website, which is hawkinsash.cpa.
Jeff, thank you for your time, and we'll talk to you next week here in Tax Insight on the Lakeshore's Good Neighbor, WOMT.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs. Part of your business, part of your life.